Are you a real estate investor or you're considering getting started in real estate investing? When someone says asset protection, you think insurance? Well, I'll tell you what, you need to get your thinker fixed because that's not working. Hey, in this video, I'm going to break down for you the problems real estate investors who rely upon insurance can run into if that is their only backstop when it comes to asset protection planning. All right? Let's get started. Okay, so why am I here today? Well, I'm here to drop a truth bomb on you that could probably save your entire investing career. Listen, your landlord insurance by itself is not the asset protection shield you probably think it is. In fact, if you're relying solely on it, it's one of the biggest and probably most dangerous mistakes you as an investor are making right now with your real estate investing. So what I want to do is I'm going to pull back the curtain today on the hidden loopholes and some surprises that insurance companies use to get themselves out of having to cover claims. We'll look at real cases. I'm going to share with you some numbers and give you these straightforward facts that many times you do not hear that you need to hear about when it comes to protecting your investments, because time here is critical. And so many people get this wrong. In fact, I was just talking to a client the other day. It was a three-way call with their local attorney who they've used for years, but they're coming now to work with us and they're talking about setting up an asset protection plan. And the attorney sat there the entire time. Well, they can just get insurance. And they kept saying the solution to this is insurance, that entities complicate their life. And you know, there's those situations where you realize, hey, you just want to jump on them and say, stop with this insurance stuff. Obviously, you have not been exposed to the problems insurance can create. So for those attorneys out there and you real estate investors that are not exposed to this, I'm going to kick things off with what I call the habitability catch-all. Now see, this is the catch-all clause, that one that can instantly void your entire defense in a lawsuit, all because of one word: habitability. So imagine this: you got a tenant on your property, they slip and fall on your property. Now that's typically what liability insurance is for. You go out and you buy your policy and you think, oh, I'm covered for that type of stuff, right? Your policy should defend you. But what happens if the tenant's attorney in that lawsuit also includes, because attorneys love to do this, right? They want to run up the damages by saying, look at all the problems this person has created for my client. They're a bad landlord. So they make allegations such as unsanitary conditions, maybe lack of heating, or they might say bed bugs, which is a big one right now. Basically, what they're claiming is a habitability claim. Now, here's where it gets scary. And in fact, there's a 2022 California case, 24th and Hoffman Investors versus Northfield Insurance Company. I'll put a link in the show notes below so you can go, and if you want to read it, you can read it. But it should be a wake-up call for you, because they actually confirmed this nightmare scenario. Because in that case, the court ruled that if your policy explicitly excludes a suit that also alleges a habitability violation, then the insurer owes you zero defense. So even if the other claims like property damage, slip and fall, the personal injury stuff would normally be covered. No, if that other attorney alleges habitability, then you're not covered. And we're talking, tens if not hundreds of thousands of dollars you're going to be on the hook for before you even step foot into the courtroom, because you have to pay for the defense all on your own. Now, why do insurers do this? Well, it's real simple. You see, habitability lawsuits, they're expensive. You get into these areas that they don't want to be fighting because they often lead to multi-million-dollar payouts for things like mold or pest infestations. By adding these suit-based exclusions, what they're doing is they're creating a legal escape clause for themselves, and they're leaving you, the investor, completely exposed. And most of us who invest, if we're not reading our policies, you're never going to catch this. That means your liability insurance in many cases becomes an illusion to you. And so when I sit down with investors at my events and they'll bring up the insurance, the first question I've always asked them: have you read your policy? Now, if you're on this right now and you're watching this, have you read your policy from front to back? Most of us get our insurance online, right? And so you don't even download the document, so you don't know what exclusions are inside of that. Well, habitability is one of those. Now, that's not the only one you need to be concerned about. So next up, the deadly distinction between vacant and unoccupied, that's another problem. And most new investors know about the 30 or 60-day vacancy rule. Okay, now you might be thinking, all right, my house isn't empty, you think. But I want to show you two cases that prove just how thin that ice really is if you're relying upon that. The first thing we're going to do is we're going to look at this Texas case. And this is the case of Green Farmers Insurance Exchange. Now, here we had a homeowner in Irving, Texas, that had her house damaged by a fire that spread from a neighboring property. She didn't even start it, right? She wasn't even there. She'd moved out several months prior, leaving the house vacant for more than 60 days. Now, her house burned down and she brought a claim. The Texas Supreme Court ruled in favor of the insurance company, who denied it. Why? Because the vacancy clause wasn't just a technicality, they said. It was a material provision. And it didn't matter that the vacancy didn't cause the fire. The court said that the moment the 60-day clock hit zero, that coverage for the dwelling simply vanished. So she received nothing for a fire she had no control over. You see, they used this 60-day clause against her in her contract, and she probably didn't even realize it at the time. But the fact of the matter is, you don't read your policy, you're never going to discover this. Now, you might be thinking, okay, but I won't leave my property entirely empty for 60 days. Well, let me introduce you to a win that's actually a warning, meaning this. The person in this case, the insured party, they actually won, but it's still a warning for all of us. So in late 2025, I think it's called Chabad, New Mexico, this case made headlines. You see, an insurer tried to deny a fire claim after 2 arson attacks against this building because he said the building wasn't being used for customary operations. Now, the policy owner ended up winning this case because they were lucky enough to have enough chairs, because this was a church, and tables and books inside the property to say, well, they could have operated it, but they weren't operating at that point in time. So if they cleared out the building for renovation purposes, then they would have not been covered, and that would have wiped out their policy. But the insurer's first instinct was to say, hey, no coverage here. Now, why is this all important? Why am I going to bring this to your attention? Because as landlords, when we have a property and you have a tenant move out, let's assume they destroy the property. And now you have to go in and you're going to do a turn, but that return is going to take extensive work. Maybe it's 45 days, 60 days, possibly 90. You're trying to line up contractors to do the work. You see, many times in policies, once you go beyond that 30-day limit, anything that goes wrong on that property, you're completely exposed. And so what do you need to do then? You're scratching your head right now saying, well, Clint, you're not giving me any answers. You see, this is why you need to go back to your carrier, right? You need to look at your policy. You need to say, hey, what happens in this scenario? Okay, if you don't cover me, how do I get coverage for that? You see, these things may be obvious to some of us, but to a lot of people who are investing in real estate, they've never heard of this information before. And what's even worse, it can get tighter. Now, I'll talk about a Washington state scenario, that's where I'm located right now, where you don't even need 30 or 60 days. You only need 10. So here in Washington, a few years back, a homeowner was in the process of moving, and they recently moved into their new house, and they still own their previous home, right, which was on the market, and they were trying to sell it. Now, they've been away from that older property for only 10 days when a refrigerator line burst, causing a massive flood in their kitchen, which amounted to tens of thousands of dollars in water damage. The insurer denied the claim. Okay, why did they deny it? Well, their argument was, hey, the home was vacant. It was unoccupied. Because the family had moved their primary living activities to the new home, okay, and so they're no longer routinely living in this property, the insurer argued that the homeowner had failed their first line of defense by not being present to discover the leak quickly enough. So this unoccupied clause is also a silent killer. So you're thinking, well, Clint, I'm not you're talking about home, my personal residence, not my investment property. Hey, this still applies, right? But applies on the other side, as I stated earlier, on the 30-day thing, 30-day requirement. I just want you to know that this is what insurance companies can do to your policies if you're not aware of that. So how does this happen? It can happen during renovations, between tenants, even if you're just taking an extended vacation. Many policies can void critical coverages like water damages or vandalism after as little as 14 to 14 days of a property being unoccupied. So you could lose your entire investment because of a pipe burst or an unnoticed break-in simply because you were not physically there or somebody was not physically there in the property. Now, let's talk about why your fire, mold, or even vandalism claims might be denied. Now, see, this is the other big one, is environmental. So when you have rental property, and this is something that just came up, I was scanning some real estate groups on Reddit, and somebody posted this picture of a house where the tenant had just moved out. Now, this property, this rental property, originally was the owner's primary residence. Then they turned it into a rental. Somebody resided in that property for 2 years. They moved out, and then they just leased it to this new couple family for a year. Well, in that 1 year time, they had pictures before the recent tenant moved in versus after. The property was pristine, but when these people moved out, it was covered in mold. Now see, that is an environmental contamination claim, and if those people who moved out were to bring a claim against this individual who posted these pictures on Reddit, yeah, he's going to be on the hook, and his carrier will not cover him. You see, insurers are incredibly skilled at reclassifying damages and types of claims because their goal is to push it into the maintenance or neglect bucket or an area where they're specifically denied coverage. And when it comes to environmental, you're probably never going to be covered under that because the cost can get too high for the insurer. Black mold is a nightmare scenario that leads to multi-million-dollar health lawsuits. If you just went out and Googled toxic mold or real estate investor mold cases, you're going to find lots of news articles where people have won $10, $20 million based upon these verdicts or based upon these claims that are brought against them. And typically happen from humidity or small leaks, or the tenant creates the problem. All right, but they'll put it back on the landlord, and they'll say, well, the landlord didn't mitigate it. They did poor maintenance, okay? And so the landlord's responsible. That's not the case in many of the situations that we've had our clients dealing with. You see, then there's the infamous incomplete remodel trick, and this comes out of a Florida case in late 2025. And so here's the deal. This landlord here, he has a property, and he found it gutted, walls smashed in, appliances stolen. It was clearly over $100,000 in vandalism claim, right? Because his tenant that he was removing from the property, they just went freaking balls out against it to say, I'm so upset with you, I'm going to tear this property to pieces. Well, you would think this would be covered. Well, it wasn't, because in the eyes of the insurer, okay, Citizens Property Insurance Corp., they denied the claim, arguing that the damage by the tenant wasn't vandalism, it was theft, which has a different lower limits, or an incomplete remodel by the tenant. It was what they're also arguing, saying that the tenant just screwed up the remodel. So they're just grasping at straws here because they can use those straw arguments now to deny coverage. Essentially, they said that the tenant damaged it during their occupancy, making it a tenant issue and not a covered act of vandalism, because it was the tenant that did that damaged the property, and it wasn't vandals. So the landlord was left having to cover this bill. So what is the takeaway here? Okay, it's crucial. You know, if the insurer can argue the damage was preventable, gradual, or related to something other than a sudden and accidental event, they're going to find a way to deny you coverage. And trust me, they are experts at finding these arguments. So if insurance isn't the whole solution, what is? Well, if you're a real estate investor, especially now in this type of environment, what you need to understand is the true power of asset protection is not relying upon insurance, it's putting together business entities. And on my channel, I give you lots of different strategies about how to do that, okay? Because you don't want to be left in a situation where your insurance carrier has denied covering it and you have to come out of pocket to pay that claim. And sometimes those claims can be extremely high, and we don't want to be stuck in that position, of course. So what do you want to get out of this? Listen, do not rely upon your insurance. It's really simple. You still have to have insurance, but it should not be your only defense. What you want to rely upon are business entities. You want to put together the right type of entity stack where you're using a holding company with specific entities for each of your properties to ensure that the liability associated with that asset stays contained inside of that one company, so it becomes a legal firewall. So if your tenant sues, they sue the LLC. And if the insurance denies coverage, well, you know that your risk of loss is limited to the equity that you have in that LLC at that particular point in time. Listen, real protection begins when you have a game plan, when you have a strategy, and you put something in place. What I want to see you do now from watching this video is take some action, learn some more, watch the other videos on my channel, and if you want to set up a free strategy session, go into the show notes. There is a link in there where you can schedule a strategy session with someone here in my firm that will walk through with you how to structure your investment real estate to make sure some of the perils that I talked about in this video, if they do happen to you and your insurer does not provide you coverage, well, you know you got a backstop there to preserve your assets from losing them in a lawsuit. Hope you got a lot out of this video. Be sure to smash the like button if you like it. I wish you the very best with your investing.